What is up, Prop Shop? Austin Trades NQ, founder and owner of the Prop Shop YouTube, coming at you with video number 2 in the Masterclass series today, Trading Entries Masterclass. We're going to continue this long format approach to in-depth trading lessons, building on the simplified approach to the lower time frame, shorter format trading lessons that we have in the channel already. Today, specifically, if you haven't checked it out yet, there is a video on the channel, Trading Entries Simplified, that is going to be kind of the introduction to this specific lesson. However, today, I want to break down some verticals for you guys that I think are really important before we start the video so that you can know exactly what you're going to leave this video with. 1, identifying market conditions, meaning when I should be trading, when I maybe shouldn't be trading, and what that looks like to me with some key terminology around expected value, balanced markets versus imbalanced markets. 2, what do these entries actually look like, on the 15-minute, on the 5-minute, maybe even on the lower time frames, and how am I identifying high value areas to trade where there's momentum, whether that's in premium, whether that's in discount, or just trading with a trend in general. 3, how can I actually replicate these entries into my playbook day over day and use an actionable exercise, something that's real that I can do on a day over day basis to build confidence in my strategy? So without any further ado, Technical Entries Masterclass, let's get right into it. Today is Saturday, January 10th, and Friday, January 9th, 2026. Was a beautiful session to review from a technical price action perspective, and we're going to do exactly that because markets from vertical number 1, balance versus imbalance, expected value being positive or negative, terms we're going to get into, did multiple things on Friday. I think markets went from balance to imbalance, expected value went from low to high, and we saw multiple opportunities throughout the session on Friday to trade an imbalanced market with high expected value. So that looks to me like identifying where a potential range is going to be within a session and identifying where I would be a buyer in discount, a seller in premium, or potentially waiting for a break of range to trade with trend. These are what I would call, in simple terms, balanced versus imbalanced markets. And if markets are in balance, for the trading technicals specifically, they're going to be a market that's ranging between local swing highs and local swing lows. We talked about it in the Trading Zones Masterclass. For me, that's going to be on a really 5 to 10 day rolling period because I'm trading on the 15 and 5-minute time frame. Now, you'll notice Friday, January 9th, 2026, as we're getting into some higher level technical ideas here, that I had 2 zones on my chart. I had a 15-minute pivot high. This was the swing high from Thursday. It was the prior session's high. And then I had a low, which was technically speaking Thursday's low and the low of the week. This was our swing low. This in the short term was our swing high. Prior session's high, prior session's low, connecting this to that weekly low. So in simple terms, this low of the session would have been, or the weekly session, discount or potential demand. This prior session's high, this zone, building on concepts from the original video, Trading Zones Masterclass, would be premium, or technically speaking, just a break of range to the upside for an uptrend, a break of range to the downside for a downtrend. If markets were to stay balanced, in a balanced market, buyers and sellers are agreeing on price, I would look to be a buyer in discount and a seller in premium. And that was effectively my plan for the session going into the session on Friday, January 9th. You'll notice we did have a low of the day. We had a low of the overnight session, always plotting these levels on the 15-minute time frame, right? 15-minute lows, this was actually candle wick to candle body. And so you'll notice we had this local swing high, the intra-session swing low, and the weekly swing low. These were the key pivots that tell me if markets will stay either balanced or imbalanced. If buyers bid the markets up at the overnight lows and the weekly lows, these would be good places to potentially be a buyer in discount. If sellers want to sell the market at 800, this technical swing high, prior sessions high, this might be a good area to sell the market in premium. And notice this prior day's high also was acting technically as a rejection area of the overnight highs. And without layering these levels on top of each other and getting too complicated here, I simply used my process from Trading Zones Masterclass to identify yet again, like I always do before any trading day, where is discount, where is premium, and where will there be range expansion so that I can potentially trade with trend into an imbalanced market. Now, if you're still following along, in real time, I'm setting alerts at these levels before the day even starts. And we're effectively just using that to identify, hey, if I'm going to take technical entries, which we're going to get into very soon here, what would that look like based on my directional thesis? What would my directional bias be before I look to take an entry? And this is so key because I think so many people wake up, they have a strategy, and they just react to the market, or they trade the market itself. I'm a big advocate for trading your playbook, your technical setups, and seeking to almost be a hunter and to wait patiently for your playbook. That's what I'm going to get into today. But before we even do that, as I've articulated in this video, we need to have an understanding of what market conditions are. I don't want to get short into a short technical pattern if markets are trading in discount. I would much rather wait for a break, former buyers to become current sellers, and now I'm trading into a high probability short side technical pattern with conditions and context in my favor. So noticing that again on Friday, January 9th, 2026, we had a market that opened up within this discount premium and was pretty balanced from a technical perspective to start the session. Lots of lower wicks, some upper wicks, and really no price expansion to start the day. What does this mean from an auction perspective? What does this mean from a technical perspective? Buyers and sellers are agreeing on price. And so when people get so eager to trade and really just looking to trade setups after setups, as opposed to being a professional, identifying where the high value areas are, identifying if there's clear and obvious momentum, and then waiting for the setups in my technical playbook. And so now that we've identified market conditions, we can understand very clearly that if I want to be an active participant in the auction, I need to have an entry model that satisfies both balanced and imbalanced market conditions. For me, I have categorized those as continuation trades in imbalanced markets and reversal trades in balanced markets. There are going to be subcategories as to what those look like. We're going to break those down on film today. And without any further ado, let's get into vertical number 2, covering now so far in a very short time period here, what do market conditions specifically from a terminology standpoint, and what would it look like from a price action perspective very quickly here to recognize where is discount, where is premium, and what is price doing in between, largely staying balanced in between. And one of the setups that I would be looking for on a consistent basis within the context of my reversal models would be being a buyer in discount or being a seller in premium. And so we're going to blow up this MNQ 5-minute chart here. We're going to identify this 5-minute time frame model of an entry that I'd be looking at from a price action perspective and kind of giving you some context as to what that workflow looks like for me day over day. First 15 to 30 minutes of the session, per usual for me, I'm staying patient, I'm staying calm, order flow is really active, and unless we get a clear break of structure, we see a clear higher high, higher low above premium into a trend, a clear lower high, lower low below discount into a trend, then usually I'm sitting on my hands waiting even if these zones are being tested. Now, after the first 15 to 30 minutes, market participants had a time. News is usually released at the top of the hour, 10 a.m. Eastern time. I'm pretty much actively looking to be up to trader, wait for my playbook, execute trades within the context of what the conditions are. And Friday, January 9th, it was pretty obvious that once we saw this trade form off of discount, right? We saw a 5-minute sell and we broke a low of day. And I think a lot of momentum traders that use maybe EMAs or something along that nature might be looking for like a retest of an EMA here. Granted, we were not yet below the overnight lows, and we had yet to see an expansion move to the upside. However, this hold of this low, this candle wick that got eaten to the upside, big shout out to Linda Rashke, a great follow on Twitter, one of the OGs in the trading industry that gives such high quality technical analysis, and technical insights. She would call this eating the wick. You don't really want to say that too fast, but this is called eating the wick. This is a sweep of liquidity for those that use different concepts. You notice this candle body pushed below these lows, closed back above it, and then saw a subsequent close above it. This would technically be a lower time frame sweep of liquidity. I'm only saying that right now to say this is a trade within my playbook. However, I do view these as technically a bit lower probability when they're done on the 1-minute, 2-minute time frame. For context, Before we get into the more systematic approach to my technical system in terms of entries, this is a clean sweep of liquidity. I want to cover this here because I know someone's going to comment about it in the chart or in the comments on YouTube, excuse me. But we did see a really nice expansion move. And as I covered already in real time on Friday, January 9th, what are we identifying here? Not where can I trade and be right? What are the conditions? And am I trading with those conditions? This is what I call trading with positive expected value. Expected value is really going to be the probabilities of blank happening more than blank with less risk than X versus Y. And that might have been done really quick and really unprofessionally, but it's pretty simply put. The probabilities of something happening more than something else happening with more reward than the potential risk. That would be a high expected value environment. If I could flip a coin and every time it's heads, you make twice as much as it's when it's tails, then I don't think any of us need to be PhDs in statistics to recognize that in a 50-50 game, if you get paid twice more than you will lose, you're going to make consistent money over a long period of time or over a large sample size. So, trading in these more balanced conditions prior to that break of range isn't low expected value necessarily. But what is extremely high expected value is waiting for these breaks of range and trading with momentum and with trend. So as a momentum trader, I need to make real-time decisions intraday that are something along the following. Will this individual trade cause me more pain to lose or to miss out? This is a sweep of liquidity. And from technical perspectives, if you don't know what that is, there were stops below discount, right? So if you're a buyer here, you would have sell stops below this. Those sell stops got taken. And now as price moves back above prior structure, you notice this prior low, we see an aggressive move above it. There's most likely short covering from an auction market theory perspective above these 660s, 680s, where anybody that went short below these prior lows is forced to now cover into a move back into premium. And this is the auction happening in real time with zone-to-zone moves happening as we've talked about on the channel. So now that we've covered conditions, we understand premium, we understand discount, we understand this is a sweep of liquidity, and hopefully we understand to an extent what is expected value. I could take this trade, but it does come down to, will I feel more pain losing or more pain missing out? That's not something I can answer for you. Again, this is not financial advice, but it is something you need to be capable of asking yourself to have self-awareness of in real time. I waited, markets moved out of balance into a trend, so we have an imbalanced market, and I want to identify the areas where I could potentially be a buyer, right? Because price moved above premium, and now that we're trending to the upside, where could I potentially buy this market? And this is the tricky part. We need to have technical setups in our playbook, not trade the market itself. Now that we've established conditions and we recognize that in these balanced markets, there are sweeps of liquidity at discount and at premium. And there's going to be the concepts we've talked about on the channel called second buyers and second sellers, which we're going to cover in a second here as well. However, in an imbalanced market, I'm not looking to just trade when things look good, quote unquote. I'm looking to trade my playbook. And I know that for a certain fact that trading into these zones, opening ranges, premium and discount, and holding these zones with a second buyer or second seller on lower time frames is the most actionable technical trade within my system. This could be considered a break and retest, but I think a really clean break and retest would be a candle close above this zone and a candle closure that retests it and closed back above it as well. We're going to cover that soon. That is also a very high probability technical continuation trade in my playbook. But since we've already differentiated between two different market conditions, we've recognized that we need to be capable, if we want to be serious about trading, of trading both conditions. Then within the context of a balanced market, I have reversals, which are sweeps of liquidity, and second buyers and second sellers. And the beauty of having a simple system is that even in a trending market, I have a break and retest, which we did not get here. But the second buyer model, because it's a price action concept, continues to be actionable in a trending market as well. These are simply going to be Wyckoff methodology principles laid out on lower time frames in a more fractal kind of 1 minute, 5 minute approach. But again, going to highlight a long setup here that I did take. I traded this, posted it on Twitter. I traded this live with the group as well. I was long into the second buyer here on the NASDAQ because this zone from the open, where were sellers at? Premium. What did we break above? Premium. What did we hold on the retest? Not the zone itself, but the same technical area that these sellers stuffed the market early became support. So former resistance becomes current support, and if we don't look at auction market theory from such a complicated lens, I have a very simple technical trade idea that all I needed to do was wait for buyers to step up, not the first time, but on the right side of the V. So in real time, it might look like this 5 minute candle is really, really actionable, and it was. This would technically be an opening range high, break, and retest. This is a trade in my playbook, and that's what's key. But more than anything, this is a very high expected value trade because markets already broke range and retested them. So if you struggle with waiting for high quality trades, if you're always finding yourself rushing into trades early, you either have a dopamine/discipline issue, or you haven't really built a playbook that reaffirms to yourself that, hey, I am taking trades, not chasing the market, not trading where I think the market's going to go next, but trades that are in my playbook. Data that I have built that you can get on a video and talk about. You can go somewhere and talk about it, and there's no hesitation to have confidence in it, right? This 5 minute setup is an opening range high, break, and retest, but because we were below this zone that I was looking to trade, I waited for a second buyer. We say a wick on lower time frames, a move higher, and then the 5 minute candle closed right here. And this is where risk to reward is a little skewed. That's why I say in real time, if we get a 5 minute candle close, is actually right here, not skewed at 775, then I need to decide, hey, am I going to long this 1 minute engulfing candle to the lows? Or if zones are going to hold, am I going to see another chance to trade into a higher low on these lower time frames, right? Because again, as I've already detailed in other videos, we've established the market conditions. We are now trending. So the fear that you have, the micromanaging of these positions, is over controlling something we don't need to control. Once buyers step up on this 1 minute time frame, I see the 5 minute candle close and hold the opening range highs. My directional bias is established. We broke above premium. We're holding these opening range highs. This is a quality long opportunity from a horizontal standpoint. And that's what this is all about. We could overcomplicate the granular technical setups, but from a horizontal standpoint, we are basically making bets that say something along the lines of the following. Is the market going to go higher or lower? And how much risk do I need to find out? Well, these entry models allow you to trade with higher probabilities and clearly defined structure to place risk and reward. Waiting for the 5 minute close is actionable. It's also higher probability to take one of these bids, the 1 minute close or the third 1 minute close, using this structure and the green chart that we already established, right? This green line at 755. So I got long into this here. I did post this on X. This was posted as a trade review as well. You can check it in real time. This was traded with analysis and execution into a 100-point move into these highs. We got a high of day out of this. It was 100 points away. And this is another really good example of understanding the auction, right? What happened to this trade once we broke above pivots like we just talked about before? The same concepts happen over and over again. We held, we got above the local high on the lower time frames, and because markets are imbalanced and trending to the upside, this technical trending retest of the opening range highs with a second buyer on lower time frames provided a clear and obvious break of structure, and then accelerated buying into a trending market, right? Imbalanced markets into new highs. So to simplify, we have a sweep of liquidity in a range-bound market. We see a market move out of range into a trend, right? Balanced to imbalanced. Markets retest structure, former sellers become current buyers. And more often than not, those buyers are going to give you more than one opportunity to trade into the horizontal trend. Expected value is established at this point. There is positive expected value. We have a market trend into the upside. And once we held this, we pushed higher. Buyers are clearly in control. Multiple different breaks and retests happened throughout the session on Friday. So I'm going to highlight, of course, in hindsight, we had a great trading session Friday though, where some technical break and retests were, and then we're going to kind of slow this down, get back to those key verticals, establish conditions, identify the technical setups, and then break down a process for you to actually go integrate into your daily routines, your weekly routines. Now, looking at the 5-minute chart, we have candle body to candle wick. On the 5-minute, I actually like to use the open of these 5-minute closes of these candle bodies, because this is going to be where these sellers began to push these buyers underwater, right? Sellers took over in the short term. We see the retest. We move higher. So when we held this zone, which would be another green line, candle open to candle wick, we held this. This is a beautiful break and retest, and the same price action concepts play out over and over again. It's fractal. We've talked about this on the channel a bunch, and it's well within the expectancy of my momentum system. We see a buyer step up off the pivot, and again, maybe you don't love this 5-minute candle for a trade. Well, we see a second buyer step up on the 1-minute as well. We hold a higher low. We have a clear zone and level to place risk if we wanted to now. Risk below the swing low, which would be here, targeting this new high, which would have been there. 15 points of risk probably at that point for about 45 points of reward is a phenomenal trade. And as I go highlight some of these for you, right, we have a clean technical break and retest. We covered this already. We're risking at the time, I was risking about 35, 30 to get quite a bit more. I did not take this trade, so not going to highlight it. We have multiple different technical opportunities, no indicators to recognize what the auction's doing in real time. For my system, it's going to look like the following. Trading a sweep of liquidity or a second buyer in a balanced market at specifically discount. Trading a sweep of liquidity, which we kind of saw off the open, or a second seller into premium. Trading a imbalanced market, right? Trending markets, continuation trades. I'm looking for a break and retest, which we saw a beautiful break and retest even later on in the session. I'm going to highlight this for you quickly. Markets held this candle wick to candle body once, twice, 2 moves higher. Sweeps of liquidity, breaks and retests, second buyers, second sellers. I just covered my entire lower time frame momentum technical system from a conditions and entry standpoint in about 22 minutes. We're going to get into details a little bit more here on execution and the exercise you can do to technically bridge the gap between confidence and consistency. But I want to highlight for you guys again, conditions come first. The reason I'm slowing down and teaching the way that I'm teaching in this video is because everyone loves to talk about technical entries. But I really think the experience that comes with taking high quality technical entries is the ability to differentiate between, is the market high expected value or low expected value? If you need some help remembering what that is, kind of refreshing, Lance Brightstein has some beautiful videos on YouTube about expected value, and it's a common finance term that you can go ahead and Google or Grok. Use whatever AI tool you use to learn about these things if you need to. However, understanding conditions comes first. Once those conditions are established, we can then wait for our alerts to go off in premium or discount. We can wait for the market to break above key levels. That's at least what I do. And if we have a playbook and we're not looking to actually trade the market itself, these setups will show themselves time and time again on different time frames, whether that's NQ, ES, RTY, the Dow, gold. These setups will continue to show themselves in supply and demand economic efficient markets. Now, we've covered the technicals, conditions, entries. What exercise can you really do to take these trades to find confidence in your system and your process? Backtesting is a little bit dangerous. I talk about this in real time. But what we want to establish is a time frame based expectancy to build confidence in your body and your mind and your nervous system. This is what that looks like. I don't know what job you work. I don't know when you're on the screens, but for you, You need to determine a time frame that you're going to trade where your momentum-based edge will provide consistent opportunity week over week, not day over day. For me, I'm a full-time trader, 6 a.m. to 9:30 a.m. I'm on the West Coast. That's going to be when I'm looking to trade my process with focus, clarity, discipline, and consistency. And I understand that my edge is going to appear on average with 2 really high quality, positive expected value trade opportunities on a day over day basis, resulting in 10, most likely, high probability trade opportunities week over week. This provides me with clear goals, clear self-awareness, and clear clarity of what it is that I'm supposed to do day over day. Be very disciplined. Wait for those 2 opportunities on a daily basis and don't force anything less or more than that, because it averages out to about 10 opportunities or 30 to 40 a month. If you're capable of taking the chart, and reflecting both kind of in real time and in hindsight on how many of those opportunities were present day over day, week over week, and what I call bridging and closing the gap between your potential opportunities and what you actually executed. For me, establishing conditions, drawing my zones beforehand, and understanding where I would have been trading from left to right. This is Thursday. This is market close Thursday into market open on Friday. So if I look at market open Friday, I go into the first 30 minutes, which I'm usually not trading in those first 30 anyways. What did we get in those first 30 minutes? A balanced market with a leaning towards sellers, but we held this zone and they ended up sweeping it. So if you look at it this way, you can see why I didn't take this trade on Friday. The only thing I saw at this time on Friday was a selling market into discount without enough confirmation, no second buyer, to really fade this break of structure to start the session. Markets moved higher, and what was I looking for after this? On the 5-minute time frame, 15-minute time frame, a retest of structure. As markets came back into this opening range, we held, and I looked for a second buyer on the 1-minute, 2-minute, and now my trading system has provided one really high quality opportunity to trade after markets showed their hand in clearly established conditions before 9:30, 10 a.m. Secondly, markets continued trending. I was in this full move for 100 points, and we got a second and even a third break and retest before markets really started to consolidate into the New York lunch hour, as they usually do, and create a little bit of a lunch box, a range box during lunch throughout the New York session. This is the daily work, the weekly work that sets you up to have consistency in your edge, your data, and your process. For 5+ years now, I have gone every single day and reviewed on the NASDAQ, on ES, and on gold how many opportunities on a day-over-day basis my system will provide, both right after the day ended and right after I got done trading for my time frame. So again, we need to establish market conditions first and foremost. Is the market trending or balanced? Where is discount and where is premium? Once we've established those conditions and set those alerts, we need to build a technical playbook that satisfies the conditions of the market. I personally look to trade reversals, sweeps of liquidity, and second buyers, second sellers when the market is trading in a clear range. When markets are balanced, that doesn't necessarily mean that they're lower expected value. It just means that I need to be trading those technical entries, right? Sweeps and second buyers, second sellers in the appropriate trade locations. I want to be a second buyer in discount, and I want to be a second seller in premium. That puts me in a high expected value trade environment, even if the general context is neutral or slightly negative expected value. Because if this market were to range all day, everything in the middle is noise. 680 to 760 would be complete noise. But 800 to 640, if I can buy 640 and sell half at the 50 and sell the other half in premium, and if I can sell in premium and sell half at the pay line and sell the other half in discount, then that's a high quality trading session. And we will see trading sessions like that in the future. If markets want to break range, as they did on Friday, then within the context of my technical playbook, I have a break and retest, a break and retest, a break and retest. But to really kind of execute with efficiency and real precision, I also use the second buyer, the second stage reaccumulation, right? Second stage redistribution concepts on these lower time frames to kind of serve as order flow and to really identify what I call these second buyer models that we all have reviewed on this channel so many different times now, and that we see form clearly day over day, week over week. Lastly, if you're finding value in these videos, more than anything, minus liking, minus subscribing, minus commenting, I really hope you actually apply a consistently intentional approach to your technical process. Not looking at every single strategy as either a holy grail or as flawed, but as the fundamentals of any high performance endeavor. Learning the auction in this specific case, learning the tools and the fundamentals necessary to be consistent, but then putting in, excuse my language, the fucking effort to just go build your playbook, to go understand what these entries look like, and to reverse engineer them both in real time and day over day, week over week, by building a bridge between the gap where you're at now and the possibility of your end game, right? The possibility of your bottom line. If you're trading off the open consistently, getting blown up before the day even starts, holding your losers too long, I don't think it's because you're incapable. I think a richer understanding of market mechanics, getting into the nuance of why are markets moving the way that they move and what does it really mean? But then distill that down into a data-based playbook which acts as exposure therapy and provides you the confidence necessary to not trade the markets, but to trade sweeps of liquidity in a balanced market and discount, to be a second seller in premium, because gosh darn it, that's where the confidence comes from. Not from selling the market and then seeing it go lower, but trading your edge, your setups, your playbook day over day. If you want to stop chasing your tail, if you want to be a consistent winner, build a playbook, understand the conditions and context, assign expected value to said conditions and context, and level yourself up as a trader in 2026. This was a bit of a different approach to the masterclass videos. Technical stuff isn't necessarily my favorite. I really believe that you need a much more nuanced approach to auction market theory, building data, assigning confidence and clarity to that data. But we do need to understand what those playbook setups are, right? What does a break and retest look like? What does a second buyer, second seller look like? And per usual, tons of trade reviews coming to hopefully provide you even more clarity in your journey. I'm going to break down some more technical videos here soon, some short form content, really getting into the nuance of all these technical setups on a day-over-day basis. And if you've been enjoying the masterclass videos so far, please like, comment, subscribe. You guys know the drill. Thank you for staying this long and listening. As always, trade safe, trade well. Thank you for tuning in to the Prop Shop.